In the previous video, I showed you how to set up your price charts with the technical indicators which the advanced trend trading strategy uses for the purpose of identifying high probability trades. In this video, you're going to learn exactly why trading with the advanced trend trading strategy is going to give you an unfair advantage over the market, which will make it very easy for you to squeeze profits out of it on a consistent basis as if it were a broken ATM machine. So if you're as ready as I am, let's dive right into it, shall we? One of the things which the advanced trend trading strategy exploits to give the traders who trade with it an edge over the markets is trend following. In case you didn't know, trend trading is one of the easiest ways to make money in the financial markets. And don't just take my word for it. Ask any professional trader who knows what they're doing. I'm pretty sure they're going to agree with what I just said. In fact, I lost money through forex trading on a consistent basis until I came across trend trading, and alhamdulillah, since then, my trading has improved by leaps and bounds beyond my wildest imaginations. If you've been trading for any length of time, I'm pretty sure you must have noticed that price does not move in a straight line even when the market is moving in a particular direction. In an uptrending market, price will move up, and then it will pull back a bit, and then it will move up again, and then it will pull back a bit. Conversely, in a downtrending market, price will move down, and then it will move up a bit, and then it will move down again, and then it will move back up a little bit. This 2 steps forward and 1 step back movement is going to keep repeating itself during trending market conditions until the market's prevalent trend comes to an end. This repeatable pattern in the market's price action simply means that during an uptrend, the probability of price moving higher and higher up is much higher than the probability of price moving lower to break below support and form new lows. It is actually not unusual to see price breaking above previous resistance levels to form new highs during an uptrend or below support levels to form new lows during a downtrend. The probability of price moving up during an uptrend is about 50 to 60%, while the probability of price moving down during an uptrend is only 40 to 50%. As a result of this, when the market is in an uptrend, we're going to have a higher probability of winning when we take long trading positions since price is much more likely to form higher highs. On the flip side, during a downtrend, the probability of price moving lower and lower to form lower lows and lower highs is much higher than the probability of price moving higher to break above resistance areas. It's not unusual to see price breaking below support to form new lows during a downtrend, just as it isn't unusual for price to break above resistance during an uptrend. The probability of price forming lower lows and lower highs during a downtrend is about 50 to 60%. On the other hand, the probability of price moving up to form higher highs and higher lows during a downtrend is only 40 to 50%. And as a result of this, when the market is in a downtrend, we're going to have a higher probability of winning when we take short trades since price is much more likely to keep moving lower. The advanced trend trading strategy capitalizes on this repeatable pattern in the market's price action by forcing us to only take trades in the direction of the market's prevalent trend. When we only trade in the direction of the market's prevalent trend, we're going to have a higher probability of winning whenever we take a trade within the markets. This forex trading strategy does not allow us to trade when the odds of winning are stacked against us. It only allows us to take trades when the chances of winning are tilted in our favor. The second thing which the advanced trend trading strategy capitalizes on to give the traders who trade with it an unfair advantage over the markets is its robust risk to reward ratio. If you've been around forex trading communities long enough, I'm pretty sure you must have heard traders throwing around the phrase risk to reward ratio all over the place. So what exactly do traders mean when they say risk to reward ratio? Well, to put it in simple terms, risk to reward ratio is simply the ratio between the amount of money or pips which a trader is risking on a trade and the amount of profits which they're looking to make. So for example, if you're risking $10 on a trade and you're aiming to make a profit of $20, your risk to reward ratio is going to be 1:2. Likewise, if the distance between your trade entry level and your stop loss order is 40 pips, your profit target would need to be placed 80 pips away from your trade entry level if you would like to maintain a 1:2 risk to reward ratio. Another way to think of the risk to reward ratio is in terms of your risk per trade. So if you're risking 1% of your forex trading account's capital on a trade, you're going to need to aim to make a profit target which would be equivalent to 2% of your trading account's capital if price action were to decide to hit your trading position's profit target in order to maintain a 1:2 risk to reward ratio. Another example of a risk to reward ratio is if you're risking $10 on a trade and you're aiming to make a profit of $30. In this case, your risk to reward ratio is going to be 1:3. In the same manner, if the distance between your trade entry level and your stop loss order is 40 pips, your profit target would need to be placed 120 pips away from your trade entry level if you would like to maintain a 1:3 risk to reward ratio. The modified version of the advanced trend trading strategy uses a default risk to reward ratio of 1:2 to help you to make money even if you're only right 50% of the time. This trading strategy allows us to risk no more than 1% of our trading account's capital on a single trade while we aim to make a profit which would be equivalent to 2% of our trading capital on each forex trading position we decide to take. So what exactly is the benefit of trading with a risk to reward ratio which is higher than 1:1? Well, any risk to reward ratio which is higher than 1:1 is going to give you much more room to be wrong and still end up making money after taking a large number of trades. If a trader was trading with a risk to reward ratio of 1:2, that trader could still end up making money even if he or she was trading with a strategy which only had a 45% win rate. For example, if you take 100 trades using a trading strategy which only had a 45% win rate and a default risk to reward ratio of 1:2, you're going to end up winning only 45 trades and losing 55 trades. Now, each one of the 45 trades which you're going to win is going to bring in a profit which will be equal to 2% of your trading account's capital. And each one of the 55 trades which you lose will only cause you to incur a loss which will be equivalent to 1% of your trading account's capital. When you do the math, you'll see that you're going to end up with a gross profit which will be equals to 90% of your trading capital and a gross loss which will only be 55% of your trading account's capital. Now, when you subtract your gross loss from your gross profit, you'll discover that you're still going to end up with a 35% return on investment after taking 100 trades, even though you were only right 45% of the time. And that's the power of coupling a modest win rate from a forex trading strategy which has got an edge over the markets with a robust risk to reward ratio such as 1:2. When you commit to trading the forex markets the way I'm going to teach you how to trade it in this course, you won't need to know what will happen next in order to be able to make money in this business. You're not going to need a crystal ball which will tell you what the market is going to do next in order to be able to squeeze profits out of it on a consistent basis like a broken ATM machine. So to do a quick recap, in this video, you learned that the modified version of the advanced trend trading strategy was designed to capitalize on two very important things which will give you an unfair advantage over the markets. The first of those two things is trend following, and the second is its robust default risk to reward ratio. To elaborate, trend following simply means trading in the direction of the market's prevalent trend. This strategy only allows us to take trades in the direction of the market's prevalent trend. The reason why it does this is simply to give us a higher probability of winning when we trade. Remember when I told you that in an uptrending market, the chances of price moving higher and higher up to form higher highs and higher lows is much higher than its chances of moving lower to form lower lows and lower lows? Well, As a result of this, taking only long trading positions during an uptrend is going to stack the odds of winning in our favor. In the same manner, during downtrending market conditions, the chances of price moving lower and lower to form lower lows and lower highs is going to be much higher than its chances of moving higher to form higher highs and higher lows. As a result of this, taking only short trading positions during a downtrend is going to stack the odds of winning in our favor. However, I would like to remind you that this does not mean that we're not going to come across losing trades at all, because no trader can escape losing trades, not even the hedge funds and professional institutional traders. But on the contrary, when we're only taking trades in the direction of the market's prevalent trend, we will be stacking the odds of winning in our favor as opposed to stacking it against us. We don't even need to be right all the time in order to make money through forex trading. Just like I explained to you a while ago, you could be right only 45% of the time, but still end up making money after taking a large number of trades using the advanced trend trading strategy on a consistent basis when you couple trend following with a robust risk-to-reward ratio such as the 1:2 which the advanced trend trading strategy uses as its default risk-to-reward ratio. And that, ladies and gentlemen, is the unfair advantage which the modified version of the advanced trend trading strategy was designed to give the traders who use it to trade the forex market each and every single day. So, since you now understand the reason why the modified version of the advanced trend trading strategy is going to give you an unfair advantage over the spot forex market, let's quickly move on to learning exactly how to use this strategy to identify low risk, high probability trade setups within the spot forex markets, shall we?